Now let's look at the why and which of the ETF. If you look at how the individual stocks compare to mutual fund and ETF, you'll find that the ETF give you diversification benefit as much as what you can get in the mutual fund. And management fees for mutual fund, the average is 1.4%. ETF can be as low as 0.07%. On top of the annual management fees that you pay, every year you have to pay an additional 12B1 fees. These are fees that are allowed by law for the companies to spend the money on advertising and marketing. This is another 0.07% for ETF and another maximum of 1% in the mutual fund. So you could be paying annually 2.4% on some mutual fund. So imagine being able to save 2% of your money that you have been paying away as fees over a 10, 20, 30 years time period. That's a lot of money. Intraday pricing. Well, those of you who have invested in mutual fund, you know that it doesn't matter whether you call in at 10 a.m. or 10:30 or 3 o'clock in the afternoon, you won't know the price of the mutual fund you're buying until after the market has closed. And that is a lot of uncertainty, right? Whereas the ETF market operates just like the individual stock, meaning when the market opens at 9:30 all the way till it closes at 4 p.m., there are prices quoted in the market. There's a bid, there's an offer, and you can choose, right, at what price you want to buy. You can put a stop loss, right, a profit stop, right, throughout the day. So this gives you a tremendous amount of leverage, a tremendous amount of control over what price you want to buy and what price you want to sell. Transparency. Most ETF are managed by robot. They tell you exactly what you are investing in. For example, the most popular one, SPY. If you invest in the SPY or the VOO, same thing, right? They invest in a basket of 500 stock that represent the S&P 500 index. So you know exactly what you are buying. Whereas in a mutual fund, it is often managed by a manager, and the manager has discretion over what he or she want to put into that portfolio. So you would not know anything. You will not know exactly what's inside. Yes, you may look at the last quarter snapshot of the top 10 holdings, but the top 10 holdings is not representative of the entire portfolio, right? Margin buying. Well, you cannot have margin buying when you invest in a mutual fund, but you can do so with the ETF, meaning that if you put in $100,000 and you tell the brokers that you want to borrow money to invest higher than the $100,000, the broker may lend you another $100,000, right? So you can then invest $200,000 with $100,000 of your own money and $100,000 borrowed on margin. Short selling, right? You cannot short a mutual fund, right? But you can short the ETF. But for example, going back to our SPY and VOO, right? If you feel that the S&P 500 is going to trade down, maybe you think that the Fed will raise rate, you are hearing something that that is going to shock the market, then you can go short the S&P 500 by going short the SPY or the VOO. And with the ETF, you have control over capital gain, right? Normally around October, November, people will go through the holdings and then they will say, well, I made some good money here. Uh, I'm seeing this realized capital gain and I will have to pay tax on my capital gain. But if I were to sell some of my money losing stock, I can offset that loss with the capital gain. Because a mutual fund, you have no control. Right? The mutual fund, that decision is made by the portfolio manager on your behalf. And of course, the portfolio manager have no idea, right, what kind of capital gain or loss that you have for the year. If you were to go to this website, ETF DB, ETF Database, you can see the top 10 ETF by volume. Right? I'm just going to go through the top four. Right? So SPY, we talk about this. This is the basket of 500 stocks that represent the S&P 500 index. XLF is the financial select sector, meaning that this ETF invests in a basket of financial stocks, banks and all this. Then EEM is the basket of emerging market stock, right? Well, we have this SQQQ. This is the Pro Shares Ultra Pro Short QQQ, right? This is where it is an instrument where you, if you buy this, you actually going short the QQQ. What's the QQQ? Well, the QQQ is a basket of Nasdaq stocks, okay? Right? So something like this can be extremely risky. You got to be careful. Okay. All right. Moving on. If you're interested in ESG, right, the same database, right, ETF database, can give you some ideas on where to look for ETF that has stocks that are concentrated and score highly in the ESG ranking. So here you have the environmental, you have the social, and responsible governance criteria. Using the same website, this is very useful if you are considering switching out of your mutual fund into a corresponding or equivalent ETF. Right? For example, let's take this mutual fund. Right, this is the Sun America Ginnie Mae, right, A-share fund. Right? It invests in a basket of mortgage-backed securities. Right? The expense ratio here is 0.99%. If you were to go to this website and you look for conversion, you'll find that it will pop up like one, two, three, four different ETF, right? And show you that these four ETF also uses the Citigroup Ginnie Mae Index, just like the benchmark for the South America Ginnie Mae Mutual Fund. And how much do they charge? Well, this guy charges 99 basis, 99 basis, which is 0.99%. And this one, MBG charges 6 basis, right? And this one, MBB charges 7 basis, right? So if you decide not to switch out of this Sun America Ginnie Mae into this, then your portfolio manager in this fund would have to outperform the index by 93 basis every year, right? Have to perform by almost 1% every year in order to justify you staying with this portfolio manager. Right? So here you can see, right? Most people would say, right, I think I would rather go for something with a lower expense ratio. Having said this, not all ETF charges a lower fee. Right? If you look at the more complicated ETF like multi-asset, commodities broad, you can see that they can charge what is this 0.5%, 0.55, and over here 0.7%. Right? Yes, it's still lower than a lot of mutual funds, but it's good that before you invest in this ETF, always pay attention to the expense ratio. Okay? Because this is your money that you're giving out away every year, irrespective of whether or not you make money in this ETF. This is rather interesting. Right? This ETF is BIZD, is a business development company income VNET ETF. Right? It invests in publicly traded closed-end fund that will make investment in private or thinly traded public companies in the form of long-term debt or equity capital with the goal of generating capital appreciation or current income. Right? Well, sounds interesting. And some people will be drawn towards this annual dividend and yield of 14%. Wow, that's pretty high, right? 14% when the market is, the 10-year treasury is yielding about 1%. Right? This sounds extremely interesting. However, if you were to scroll down and look at management fee, right, this fund is charging 9.6%. 9.6%, that's a lot of money that they're charging you. Okay, again, irrespective of whether or not you make money in the BIZD. So if you add it up, like 14 plus 9, that is a 23% target a year. Okay, a 23% target a year. So how does this ETF is able to have a break even of 23% a year? The answer is they probably have to take a lot of risk. And what kind of risk they are taking? Well, they are lending long-term money, right, in form of bond or equity capital to companies that are thinly traded, right? So this tells you that they are lending to companies that have that often would not be able to borrow cheaply from the banks and or not able to issue a bond in the market. So these are high risk companies. How do you choose the best ETF? Right? Well, there are several steps. First off, for example, if I am interested in investing in energy, right? So I will do a Google and I'll type in energy ETF, and I'll see a long list somewhere, right? And I'll click on that, and here I find the top 5 in terms of asset. Why do I use the criteria asset? Because the smaller ETF that has less asset are typically those that have not done well. People who invested in these would have moved away into the one that are doing better. So the larger one, will tend to attract people who understand this is a much better ETF. So look at the top 5. A simple process would just go to the name. And when I see this oil and gas exploration and production, it tells me that it is a narrower aspect of energy. Right? So, okay, fine, I delete that. And this is the oil services, right? Also another narrow aspect of energy. So I take it off. So now I have 3 right, ETF that covers the broader energy sector. Right? So I have the XLE, VDE, and IYE. What's next? Well, I then look at the top 10 holdings. Right? Top 10 holdings. And what do I see? Well, I see ExxonMobil, right? I see Chevron, J, and I look at the percentages, right? Same name, similar percentages, same name, similar percentages. So okay, fine. So that means that of these 3, there's I cannot eliminate them based on the component. Right. The next step, I look at the fees. So the fees, so IYE, okay, 0.44. No wonder you are number 5 on in terms of total asset, right? So bye-bye IYE. Okay, bye-bye IYE. So now I am choosing between XLE and VDE. Right? So if I'm lazy, I would say, yeah, let's go with VDE and I'm done. Right? However, I may want to have an additional step. I would look at the volume or bid offer spread. Okay, right? Volume or bid offer spread, because I may want to trade this in and out, right? So the narrower the bid offer spread, right, the less I give away to the market, right? So I would choose that with a tighter bid offer spread. And often the ETF with a tighter bid offer spread tends to have a higher volume that is traded on a daily basis. So this is a very simple way, right, to choose the best ETF, uh, essentially based on the fees that we are paying. Here is another example. This is SPYX. Right? So it's SPY, but it comes with the additional X. What is this? Well, this is the Fossil Fuel Reserve Free ETF. So this appeals to the green people, right? The ESG people. They like this, right? However, when I do a back test, 2016, 17, 18, right, and so on, right, I see that when I plug in these 3 ETF, the Vanguard SPY, the SPYX here, and the regular SPY, I see that they are the same line, right? They're the same lines, and I have to really screen hard to see if there's any difference. Right? So as it turns out, right, there is really not much difference, right? The actual difference is the fees that that if I were to go green and I buy SPYX, I just pay an extra like 17 or 14 basis every year, right? When the performance is really nothing substantially different, right? If at all. Right? It's also important that we take the trouble to open up the box and see what's inside the ETF. And a good resource would be portfoliovisualizer.com. And here I'm comparing Global X Super Dividend and this dynamic preferred. So both sound fantastic, right? One is dynamic, the other one is super, right? And when I look at this, I see that this has small cap, so this large cap value, and this has mid cap value. And what else? Intermediate term treasuries. Well, this one has mid cap value here. And what is this here? Global, okay, global and long term treasury. Okay, right. So this dynamic preferred has more international, right? More international holdings, and this one has more large cap and mid cap value. Okay. All right. So okay, fine. So now I know the difference. If I think that the dollar is going to weaken, if I think the dollar is going to weaken, then I would prefer to buy this. Right. If I think the dollar is going to strengthen, I would want to have less global exposure, more domestic exposure when I think the dollar is going to strengthen. Right? And when we backtest the performance, what do we see? Well, we see that the dynamic preferred had underperformed this time period, and then it outperformed and it has opened up the gap. All right. Well, okay, that's fine. And when we look at the final balance, right, and the compounded growth rate, we know that this is not the right way to look at the comparison between two funds, right? We don't just look at the final balance, right? We look at what? Well, we look at the year-on-year performance. We want to see how many years that we underperform and how badly is the pain when we lose money in any particular year. And we also look at the upside when it performed well. And we look at the Sharpe ratio and the Sortino ratio, right? So in general, the higher the Sortino ratio, the better. Like the higher the Sharpe ratio and the Sortino ratio, the better, right? Why? Because the Sharpe ratio measures risk-adjusted return. The return, you adjust for the risk, right? So the higher the risk-adjusted return, the better is that fund, right? So what do we see? Well, we see that, okay, the dynamic preferred, right, has a better Sharpe and Sortino ratio. Okay, right. Now let me just quickly explain, right, the Sharpe ratio. The Sharpe ratio would take in the return of the portfolio minus the risk-free rate divided by the standard deviation, right? So a portfolio has a return of 12% over the past year and a current risk-free rate of 3%, and the volatility was 11%. So we will take the 12% minus the 3% divided by the 11%, and we get a 0.8. If adding a new asset, right, will lead the portfolio expected return to fall to 9%, but the volatility to also fall to 6%. If the risk-free rate remained the same, then our Sharpe ratio would change. Our Sharpe ratio would change to 9 minus 3 divided by 6, and that will give us 100% of 1, right? Which is better than the 81.8% here. Well, what's the difference between the Sharpe ratio and the Sortino ratio? Well, the Sharpe ratio is based on a very old finance theory that risk is defined by how broad the distribution of return, right? How broad the distribution of return. The broader it is, right, the greater the uncertainty, right, compared to where the mean should be. Well, that is interesting, but for a practitioner like Sortino, right, he would argue that yes, over here, this is also uncertainty, as just like here, but over this side where I have positive return, this is an uncertainty that I really don't care. In fact, I would welcome, right? If I can make a lot more money than the mean, it's a good thing. So risk to a practitioner is if I were to lose money beyond a certain desired targeted return, right? This is risk. Right? Risk is defined by the downside volatility that is below the desired target return. Right? So the Sortino ratio would not take risk as the whole spectrum, but risk only on this part of the curve. Okay, right? If you run a simple Excel, right, you can just chop off one part of the curve and just focus on the left-hand side of the curve, and you can get the Sortino ratio. Right? But you don't have to do all this Excel because most of this website would give you the Sharpe and Sortino ratio. Continuing with this idea of opening up the box, right? And here I'm using Tableau to look at the data visually, and we see that when we look at QQQ that invests in a basket of stocks that mimic the Nasdaq index, we see that Microsoft represent 11.8%, Apple 11.6%, and so on, right? So we see that these stocks here account for a large part, a lot larger than the Intel, the Cisco, the Tesla, and so on, right? So visually, it gives us a good idea on where the risk lies. If we invest in GDX, right, this is an ETF for a bunch of gold mining companies, right, gold mining companies, and we would then get familiar with names like Barrick, which represents 16.4% of the holdings here, and Newmont, 12.95%, and so on, right? So again, we see that the top three here, right, represent the bulk of the risk, right, compared to smaller names like Royal Gold or Kinross and all this. Another good way to use Tableau to, again, open up the box to see what's inside is to look at the percentage and PE multiple for each stock. Okay? And here I'm looking at MOAT, M-O-A-T. Right? What is MOAT? MOAT is a basket of stocks that uses the selection process that Buffett has talked about. Buffett talked about buying stocks that have economic moat, and this would include the franchise value, the network effect, and where they have very weak competitors. So the people at Morningstar have come up with a long list, and this long list can be used as a selection criteria to pick stocks and put it into this ETF called mode, right? So what's inside mode? Well, we see that we have Microsoft here, 20.9%. The P multiple is 32 times. And we have, what is this? I cannot even see my own screen. It's too light here. Amazon, 18.2%, right? And the P multiple is 114, right? Pretty high. And Facebook, like 9% of the holding, P multiple of 29.8 times, and so on. Okay, right. So, given that more and more people uh, are being educated on how to use ETF, what we are seeing now is there have been rising liquidation, right? Rising liquidation. This red line here is red line or pink line here, because people are moving away from the expensive ETF into the cheaper ETF when they are performing the same job. Right? So in the first half of the year 2020, we have 68 new listing, 83 was delisted. Right? Among them would be Invesco shipping ETF, which makes sense because the shipping industry has been a very tough industry, and it makes sense that some of these ETF would be ignored and they lose AUM, asset under management. The surprising thing to me was this forensic accounting long short ETF that was delisted. I would have thought that this fund should appeal to many people because if you can do good accounting analysis, you can weed out the bad companies and invest only in the good companies. Right? Then we have the Wisdom Tree Russell 2000 Put Right Strategy Fund. Right? So again, this would have appealed to some people, but perhaps they did not have enough time to do the marketing, and management just put a plug and the fund died. Or it could be they charge too much and people don't want to pay up. When you look at the ETF as a group, you will find that we have a very simple ETF and we have very complicated ETF. So, for example, under equities, we have single countries, we have single sectors, right? Which makes a lot of sense because you want to buy an ETF like SPY that invests in the whole basket of 500 companies. You want to buy XLF, like XLE, which invests in a group of energy stocks. Right? Then there are very complicated, complex ETF like credit spread and currency strategies. Right? And it's important that you need to understand what is behind the scene. Right? what would the robot or the portfolio manager do with your money, right? And if you're investing in SPY, then it's quite simple. The robot would just buy 500 names, right, in proportion to the market cap, right, using the money that you invest in. And then when you want to redeem, the robot will just sell these 500 names and give you back your money. It's very simple. But look at something like this, UK property, global property, right? You can then see that it's a lot more complicated than having a robot. You need a portfolio manager behind the scene, and the portfolio manager would have to collect the money to a reasonable amount, and then they will go out to buy a property, right? Meanwhile, they may invest in the REITs, but eventually they would have to buy the underlying asset, right? And one has to understand that the ETF create this illusion of liquidity, right? And it's important to understand that not all ETF have the same liquidity. The SPY, very liquid. Gold, very liquid. But when it comes to underlying asset like properties, we know that behind the scene, the liquidity is very, very bad. Okay. And that is why sometimes you hear about funds, whether they are mutual funds or ETF, that would block the shareholders from redeeming the fund because a property fund like this cannot just fire sale the property, right? Just because everybody is redeeming today and they need to raise money by tomorrow afternoon, right? So it's important, like beyond opening up the box, beyond back testing, look at what you are actually investing in. So this concludes this section.